Hi, welcome to the Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest tiny updates in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at noon and 7 p.m. Eastern Standard Time. And here at the Crypto Republic, we give you the bird's eye view, a satellite perspective to spot the big picture shifts while everyone else is stuck in daily chaos. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. All right, ladies and gentlemen, we need to talk about something that just happened that could quietly become one of the most important regulatory signals for crypto in years. Because a senior official in the CFTC just made a statement that could eventually allow America's biggest financial infrastructure to move onto blockchain rails. And when I say infrastructure, I mean NASDAQ. I mean the New York Stock Exchange. I mean the Chicago Mercantile Exchange, some of the largest financial systems on earth. Before we get into everything, let me ask you something. If trillions of dollars in global markets eventually begin settling on blockchain technology, what networks do you think will actually power that infrastructure? Because that's the real question investors are starting to ask. And why it's important for projects like XRP, Ethereum, and other blockchain networks are suddenly being discussed in conversations that until recently only involved banks and regulators. But to understand why this moment matters, we need to zoom out first. Because every major shift in financial history starts the exact same way, with infrastructure. Throughout history, financial revolutions don't start with speculation. They start with technology. In the 1800s, the telegraph changed markets forever. Before the telegraph, stock prices could take days or even weeks to travel across the country. After the telegraph, information moved instantly. That single innovation created the first truly national financial markets. Then in the 1970s and 80s, computers replaced paper records. Trading floors slowly transitioned into digital order systems. Clearinghouses became faster. Settlement became faster. And trillions of dollars in financial activity began moving electronically. Then came the internet in the 1990s. Suddenly, everyday investors could access markets through online brokerages. Platforms like E-Trade and Charles Schwab opened the doors to retail traders everywhere. Each of these technological leaps unlocked enormous economic growth. And now, regulators are beginning to openly acknowledge that blockchain technology could represent the next major infrastructure layer. Which brings us to the comments that just came out of the CFTC. The CFTC signal, during a recent discussion, CFTC director explained that regulatory clarity for digital assets may finally be approaching in the United States. According to him, there's growing momentum behind legislation designed to clarify how crypto markets will be regulated going forward. But what really caught people's attention was what he said next. He explained that he expects the United States to move towards what he called a permissionless innovation environment. Now, historically, that phrase carries a lot of weight, because that's the exact philosophy that allowed the internet to grow rapidly in the 1990s. Instead of requiring every new startup to receive government approval before launching, innovators were allowed to build first. Regulators stepped in later if problems appeared. That environment created companies like Amazon, Google, PayPal, and thousands of others. And according to this CFTC director, a similar framework could eventually apply to blockchain technology. But then he made a statement that made a lot of people stop and listen. He said there's no reason why major financial exchanges like the New York Stock Exchange, NASDAQ, or the Chicago Mercantile Exchange couldn't eventually build infrastructure on blockchain networks. Now, think about that for a moment, because when a random crypto influencer says something like that online, it's easy to ignore. But when that statement comes from a regulator responsible for overseeing derivatives markets in the United States, institutions start paying attention. After all, this is the same agency that has historically taken enforcement actions against companies operating outside regulatory guidelines. So when leadership inside that agency begins discussing blockchain as part of a future financial infrastructure, that signals a major shift in how regulators are thinking. And when institutional infrastructure starts changing, the numbers involved are enormous. Some analysts estimate that as much as $60 trillion worth of financial activity could eventually interact with digital asset technology. Which raises a question investors are starting to ask more frequently. If that level infrastructure transition happens, how much of that activity could flow through networks like XRP Ledger? But here's where the conversation took an even more surprising turn, because another CFTC commissioner made a statement that shocked many people. Watching the discussion, it had to do with something that sounds simple at first, but actually has enormous implications for crypto. What exactly qualifies as crypto under U.S. law? The onions and movie tickets story. During the discussion, the commissioner explained that under U.S. commodity law, almost anything can qualify as a commodity. When asked what does not qualify, his answer was unexpectedly specific. Only two things are explicitly excluded: onions and movie tickets. Now that sounds almost ridiculous, but both of these exceptions come from real moments in financial history. Back in the 1950s, two traders managed to corner the onion futures market in the United States. They bought massive quantities of onions and manipulated supply so aggressively that prices collapsed and farmers were devastated. Congress stepped in and passed the Onion Futures Act, banning onion futures trading entirely. To this day, onions remain one of the only commodities that cannot be traded in futures on exchanges in the United States. Movie tickets have a completely different story. In the early 2000s, there were proposals to create futures contracts allowing traders to bet on a movie box office performance. Hollywood studios pushed back hard. They argued that speculation could distort film markets and potentially influence movie releases. After intense lobbying from the film industry, Congress excluded movie ticket futures as well. So today, the law effectively says this: if something can be traded in a market, it can probably qualify as a commodity. The definition is far broader than most people realize. And it's one reason digital assets are increasingly being considered with commodity regulatory frameworks, which could provide something the crypto industry has been waiting for years: clarity. So, why do banks need crypto regulation more than crypto needs banks? Another powerful point came from a former CFTC director who explained something that flips the unusual narrative about crypto adoption. He said banks actually need regulatory clarity more than crypto companies do. And the reason is simple. Crypto entrepreneurs are risk takers. This is very important, super important. If they can't build in the United States, they'll build in Europe or Singapore or Dubai. Innovation will happen somewhere, but banks operate differently. They have boards. They have compliance departments. They have legal teams that evaluate every new initiative. And those lawyers are telling executives something very simple. You cannot invest billions of dollars building blockchain infrastructure unless you know exactly what the regulatory framework will be. We've seen this dynamic before. In the early days of electronic trading, banks hesitant to adopt the technology, not because it didn't work, but because the regulators hadn't clarified the rules. Once the rules became clear, electronic trading exploded. Today, almost every trade in global financial markets happens electronically, and the same pattern now may be repeating with blockchain. I want to talk about the stablecoin battle in Congress. Now, the conversation also touched on legislation currently being debated in Washington. One of the most important pieces involves stablecoins. Stablecoins are digital tokens backed by reserves like U.S. dollars or treasury bonds. They are designed to maintain stable prices while allowing digital transactions to move quickly across blockchain networks. Lawmakers have been debating how these assets should be regulated. Some want federal oversight. Others want state-based systems. Negotiations have been ongoing between the Senate and the House. And while the final details are still being debated, there is growing momentum toward legislation that could define how stablecoin issuers operate. If passed, that law could unlock massive institutional participation in digital asset markets. I want to talk about central bank digital currencies. Another major topic in the discussion was central bank digital currencies, often called CBDCs. These are digital versions of national currencies issued directly by central banks. Several countries around the world are already experimenting with them. China has launched pilot programs for the digital yuan. Europe is exploring a digital euro. But in the United States, CBDCs have sparked intense debate. Some lawmakers worry about privacy concerns and government control. Others argue that digital infrastructure will be necessary to compete globally. So far, the United States has taken a cautious approach. But the broader conversation shows the governments everywhere are thinking about how financial infrastructure may evolve in the coming decade. What this could mean for XRP, you're probably asking, ladies and gentlemen. Now, this brings us back to the question many crypto investors are asking. Where does XRP fit into this picture? The XRP ledger was designed to process transactions quickly and cheaply across global payment networks. Ripple has spent years building partnerships with financial institutions around the world. And while regulatory battles have slowed adoption in the United States, progress has continued internationally. If U.S. regulator clarity emerges and blockchain infrastructure becomes part of mainstream financial markets, networks capable of handling high-speed settlement could become extremely valuable. That doesn't guarantee any specific outcome for XRP, ladies and gentlemen, but it does explain why investors are paying attention to comments coming from regulators, because policy shifts often signal where infrastructure development could happen next. Here's some of my final thoughts on this. So here's the takeaway from this discussion. For years, crypto markets have been driven largely by speculation. But behind the scenes, something much bigger may be unfolding. Regulators, lawmakers, and financial institutions are starting to seriously discuss how blockchain technology can integrate into the core infrastructure of global finance. If that transition eventually happens, the scale would be enormous. We're talking about markets measured not in billions, but in tens of trillions of dollars. And moments like this, when regulators openly acknowledge that possibility, are worth paying attention to. Because financial revolutions rarely look dramatic when they begin. They often start quietly, when policy discussions, legislation, small signals for institutions. But years later, those signals sometimes mark the beginning of major transformations. Now, I'm curious what you think. Do you believe in blockchain infrastructure will eventually power major financial exchanges? And if that happens, which networks do you think could benefit the most? Let me know in the comments. Well, ladies and gentlemen, if you made it to this part, it's time for the candy from the Italian ices. Did you guys miss me, or did you guys miss me? So much happening right now, and I apologize. I literally can't get off the phones, and right after we finish filming this, I got to get ready for the Asian Open because a lot happening. I want to welcome all the new members of the Patreon, the Crypto Republic Desk Monthly, all the new members of the membership channel, everyone. I love taking the time to chat with everybody, and I love hearing everyone's stories. But I want to break into something that just crossed while we were preparing for this video. Iran has begun laying mines in the Strait of Hormuz, the world's most important energy choke point that carries about 1/5 of all crude oil, according to two people familiar with U.S. intelligence reporting on the issue. The mining is not extensive yet, with a few dozen having been laid already in recent days, the source said, but Iran still retains upwards of 80 to 90% of its small boats and mine layers, one of the sources said. So if its forces could feasibly lay hundreds of mines in the waterway, Iran's Islamic Revolutionary Guard Corps, which now effectively controls the strait, along with Iran's traditional navy, has the capability to deploy a gauntlet of dispersed mine-laying craft, explosive-laden boats, and shore-based missile batteries, according to CNN. The IRGC previously warned that any ship passing through the strait would be attacked, and the channel has effectively been closed since the start of the war. The state of the strait has been described to CNN as a death valley, given the risks involved in transitioning. So the U.S. officials, they said today that U.S. Navy has not escorted any vessels through the strait, but POTUS said Monday that his administration was looking at the option to do so. POTUS said in a post on Truth Social on Tuesday that if Iran has put out any mines in the Hormuz Strait and we have no reports of them doing so, we want them removed immediately. He added that if any reason mines were placed and they are not removed for Fort Worth, the military consequences to Iran will be at a level never seen before. If, on the other hand, they're removed what may have been placed, it will be a giant step in the right direction. So that's big. That's just being reported right now by CNN. We're going to go through all this right now, and very much so, again, because a lot of people were just totally decimated, cut up like sushi. And again, everybody that was following the Patreon, the oil trade got out at 101 before the massacre happened. Again, and everyone's getting chopped up like sushi. People are being carried out in body bags. And towards the end of this video and this rant that we're going to go through, I'm going to explain what I've been telling family offices over the phone and institutions that we've been working with for years, and people that I have to go see later this week that we've been just introduced to. And I'll go over that more, because what's happening right now is a tale of two cities in one explanation, in my opinion. Again, none of this is financial advice, but I'm going to keep on going through what's leading to things right now. As of March 7th to 9th, multiple U.S. strategic bombers have landed at RAF Fairford in Gloucestershire. Official military reports confirmed that a total of 4 B-1B Lance bombers has arrived, with additional B-52s, 3 of them in Stratoforces, and B-2 Spirit stealth bombers expected to follow shortly, will operate out of the UK-U.S. base at Diego Garcia. So this is one of POTUS's most potential moves of crippling the entire Iranian regime, and it may be rough. Again, in my opinion, oil dropped because of this yesterday, and we're going to go through towards my next rant in this video about what's causing and why the expectations of upstream, downstream, and everything like that. But I want to get everything, what I'm telling people, my opinion, how we see everything, because right now this is influencing everything else. Again, because the crypto market's risk on, risk off, right? So we're seeing energy go all over the place and people getting up, cut up like sushi. And again, we went through a lot of scenarios that we're watching and we're capitalizing off of and we're positioning, because every day there is a new chapter in the course of chaos that we're taking advantage of, and we're putting capital to work for ourselves. Anyone takes any capacity. Again, as far as we're concerned, it's our obligation. What's happening in the world is very upsetting, but it's our obligation to take advantage for ourselves. Anyone who retains any capacity to create alpha off of this. And that's what you have to do, unfortunately, in these scenarios. Again, so the structuring of these military assets, B-52s, B-1Bs, around the two locations we just said, first was a warning to Iran, because these attacks are devastating and you're not recovering from them. Right now, what we just said that crossed the wires right now about mines being laid, that's massive. We got to stop and let that soak in for a second, because they're escalating. Oil ended today in the mid-80s, right? But that 120 move, people get massacred out of that again. Again, matcha green tea, as far as I'm concerned, the best thing. I want to pay attention to something right now, and I want everyone to understand this. I like sharing these strange factoids that I pay attention to, because I said I'm designed for this. And as a financial mercenary, again, I don't really care what happens. I just care about capturing the most alpha we can through every scenario and situation for myself and my benefactors, so that our bank accounts grow. I know that's called what it is, but being a financial mercenary, that's what it is. And if you're here with me, I love you all. That's why we're the Remors, and that's why the Wolf Packs. I'm going to keep on going. Ladies and gentlemen, one of the biggest things that POTUS could do, and it could cripple the Iranian regime, may involve seizing a tiny island where gazelles run free near oil infrastructure. There's a 5-mile island strip known as Karg Island. It's home to Iran's most important oil facility, an export terminal in the Persian Gulf that handles up to 90% of the nation's crude. It's a cornerstone of Iran's economy and a major source of revenue for the Iranian Revolutionary Guard, a pillar of the regime that experts say could put down the kind of public uprising that POTUS has called for. If POTUS intends to intensify pressure on Iran outside of missile strikes and bombings, seizing Karg Island would deprive the regime of a key funding source of controlling the population. So this has been spoken about for many, all the way going back to to George W. Bush, the administration, but it's strategic again, right? If they can't sell their own oil, they can't make payroll. That's very important in their country. If they can't make payroll, that's it. So no matter how much we bomb them, like I said, going back to the Yugoslavian war, no bombing hasn't been enough for regime change, right? Unfortunately. So no matter how much we bomb them, there's not going to be regime change until we fracture the Revolutionary Guard, according to sources. And this can be a fairly nonviolent way of bankrupting. Again, oil is the lifeblood of the Revolutionary Guard. About half of the nation's 50 billion oil industry is controlled by the force. Okay, that's according to Reuters. That includes a Ghost fleet of oil tankers that take its sanctioned crude to China. That's massive. Again, so now we're going to have to watch. We're going to see oil's ticking up right now since the whole mine laying situation. But again, what's coming in the next segment, I want everyone to take out a pen and paper, or you can rewind this and take some notes. But again, if you want to learn how we're capitalizing off of this, do join us in the Patreon, because it's a lot easier for us holding your hand than trying to make heads or tails of this, because I'm going to talk very, very fast. But this is phenomenal. What a time to be alive. So much opportunity. I'm beyond excited. I really, really am, for the ability to take advantage of what's happening. As of March 10th, 2026, if you want to look at European natural gas futures, Dutch TTF, they've experienced extreme volatility. We talked about the LNG situation with what happened in the UAE. Again, with April 26th contract reaching highs near or above 50 to 58 euro. That's rough. I mean, it's just rough what's happening with that. I mean, it's beyond. I mean, the LNG space is one of my favorite spaces right now. And we put out some calls how we're taking advantage of that. And again, seeing now, and everyone who's heard my video on the Patreon this morning in the crypto trading monthly desk, that's what we're going to be paying attention to, what I itemize, those 5 steps, and we're going to play that over and over and over again, right? And we're going to show everyone how we can apply those 5 steps to almost everything. Everything that's tradable, we apply that 5 steps to. Not financial advice, just my own opinions. Ladies and gentlemen, Part of the reason myself and so many others that I know personally in my space can't get off the phones is this is breaking. Many Hong Kong-based family offices are planning to increase investments in private equity and digital assets within the next 3 years. So they're calling around, and in our space, everybody's name's on a Rolodex, and it's a very, very small Rolodex of people who can get things done for certain people. So the Hong Kong Institute for Monetary and Financial Research said demand for private credit and venture capital is also expected to rise. Again, it's a very, very small group. Stay with me because I'm going to go right back to what's happening with the crude oil situation. I just want to get through this. Again, this is very funny. Stay with me. The U.S. Banking Industry Group is reportedly considering legal action against the Office of the Comptroller for Currency over its approval of national trust bank charters for crypto firms. Go figure that. So recent conditional charters were granted to BitGo, Ripple, Paxos, Crypto.com, and others. The Bank Policy Institute claims these licenses could increase risk. So you got to really ask yourself, what's really going on over there again, right? I like getting these crypto updates before I'm really going to rant about what's happening and why. So stay with me because this is important. We're watching things break right now. Crude's going higher as we speak. So again, Aon, on the NYSE, AON announced the first known stablecoin insurance premium payment among major global brokers, completing a proof of concept using U.S. dollar-backed stablecoins. The initiative involving clients Coinbase and Paxos settled insurance premiums via USDC and PYUSD on the Ethereum and Solana networks. That's very, very big. You know, I always bring up Bhutan because Bhutan, with their gold-backed digital currency, a lot of things, well, their state-owned Duke Holdings Investments has sold about 42.5 million in Bitcoin and USDT in 2026. It's reducing its Bitcoin holdings from 13,000 to around 5,400 since late 2024. Transfers, including those to a lot of different treasury drawdowns because, again, they want strategic metals. What happens is people take advantage of highs and lows, and they move money around the same way that I always told you that people are moving money from the quickest ways to take advantage of alpha. We just saw it come out of the energy markets, right? And that's why we saw crypto uptake. You saw the risk off, back to risk on into crypto. And we're going to get to that right now and why. Again, so I want to just go over this really, really, really right now, which is important. And I hope this is making sense to everybody, and I miss not being able to make videos every day. But again, there's not enough people in my space to go around. And when your name's on a short list of people who's true, tried, and tested, you're married to the game. And I love being a financial mercenary. I thrive on this. Also, a quick update. We will begin having our phone calls to anybody who wants them and everyone else on the Patreon starting next week. We already got that finished with compliance and everyone. So I'm emailing everybody who's already emailed about that back today when I get off the video today about that. So we're proud to offer now myself and Domenico 2-on-1 phone calls. Every phone call that you have with us is me and him on it. So now, ladies and gentlemen, very, very important. This is why people are getting caught up like sushi. Now stay with me. Stay with me. And this is why we're the financial mercenary. And this is so much Gucci clarity and Gucci conviction I'm about to give to you that if you can follow what I'm going to say, and I can't believe I'm giving this away for free, you are on your first step to becoming a financial mercenary, having Gucci conviction. So I want to walk you through what's physically happening right now in the Gulf energy system right now and explain. Despite the dramatic headlines, the situation increasingly looks like controlled escalation rather than a true supply shock, okay? My framework for looking at this is rooted in how the physical oil market actually works. Over the years, I've learned that when geopolitical tensions flare up in the Middle East, it's critical to distinguish between upstream infrastructure and downstream infrastructure. Very important. Write that down. That distinction determines whether oil markets experience a temporary fear premium or a structural supply disruption. Write that down. Understanding the difference is the key to understanding what is happening in the market today. Write that down. The physical reality of the Gulf energy system, ladies and gentlemen. A significant portion of global oil flows through the Strait of Hormuz, making it one of the most important energy choke points in the world. However, not all infrastructures in the region carries the same importance. From a market perspective, we can simplify the system into two categories. Upstream infrastructure, this includes oil production fields, processing facilities, refineries. These assets are the core of the global supply chain. If they're damaged, the effects are long-lasting. Rebuilding a refinery, for example, could take up to 5 years, not months. Downstream infrastructure, these include storage facilities, export terminals, transportation routes, and logistics. Damage here can create disruption and headlines, but it does not remove the core productive capacity of a nation's oil system. That distinction is absolutely critical. How oil markets react to conflict when tensions rise in the Middle East, oil markets typically react through two channels. First, operators sometimes shut down production temporarily. If they believe their facilities could be targeted, this is a defensive move designed to prevent catastrophic damage. Second, markets begin to price in infrastructure risk. Traders start determining and asking whether these facilities could be destroyed, and that fear alone can push oil prices higher. But again, the type of infrastructure matters enormously. Destroying a storage facility is essentially destroying a warehouse, a shed. It's disruptive but manageable. Destroying a refinery is an entirely different matter. That removes refinery capacity from the global system and could take 1 to 5 years to fully rebuild. That's why the market reacts very differently depending on what is actually being targeted, ladies and gentlemen. So the red line, the refineries and production facilities. The escalation ladder in the Gulf is very well understood by all the major players. If Iran were to destroy a major refinery belonging to Saudi Aramco, the consequences would be enormous. It'd be likely triggering overwhelming retaliation and potentially escalate the conflict far beyond where it currently sits. At the same time, the United States also understands that destroying Iran outright could destabilize the entire region and create enormous geopolitical consequences with countries like China. So what we're seeing right now is something more restrained. Missiles, drones, and symbolic strikes are occurring, but they appear to be avoiding the infrastructure that would truly destabilize the global energy system. That's why I'm increasingly viewing much of the current escalation as a form of strategic signaling, rather than an attempt to trigger a full-scale supply crisis. Current oil price structure. Right now, oil is trading erratically, up, down, left, right, all over the place. And we're probably going to see more erratic with this news, depending on what's happening. But based on the physical situation in the Gulf, there may be some more limited upside from here, depending on how the market digests, if it's real, what CNN just reported, laying of mines. Again, so oil could go much higher. It's pricing, it could go higher again if this risk blows off the top. But as far as I'm concerned, in my opinion, again, if geopolitical headlines continue to drive risk sentiment, I think the big boys will begin to sell 115, 120. They're going to take advantage of selling into that. A lot of people I know are selling into that, including ourselves, again, because it's like raining money with that. It's like going out and picking fresh fruit. But the real question is, everyone is asking whether oil can move towards 120 a barrel again. In my view, that scenario requires one very specific trigger, a confirmed strike on upstream infrastructure, particularly a refinery or major production facility. Without that, the current rally looks much more like a geopolitical premium rather than a genuine supply disruption. Again, so lessons from the last 120 oil spike, we've seen this move before, ladies and gentlemen. When oil previously surged towards 120, several things happened simultaneously. First, Saudi Aramco increased production and accelerated supply into the market. In many cases, producers will also hedge their output by selling future contracts while ramping up production. Secondly, the U.S. government likely stepped in through various stabilization mechanisms, including activity through the so-called plunge protection team, which can help stabilize financial markets during the periods of extreme volatility. Third, political messaging played a role. POTUS publicly downplayed the risk of a prolonged conflict and emphasized that the situation will remain contained. Markets took that comments seriously. There were also discussions about releasing oil from global strategic reserves, even though not all countries initially supported the idea. The main discussion of a coordinated release helped cool the market. All of these factors combined bring oil prices down. The lesson from that episode is simple. Oil prices derive not only by physical supply risk, but also by policy responses and coordinated messaging. So the market psychology today we're seeing a similar dynamic unfold. Markets initially reacted to headlines by pushing oil sharply higher, but as investors begin to reassess the situation, the realization is setting in that the critical infrastructure has not been targeted. Let that sit in. Got to marinate on this one. Critical infrastructure has not been targeted. As a result, the market's starting to question whether the current price spike may have gotten slightly ahead of itself, hence what we're seeing right now. We're also in an environment where political messaging can move markets quickly. Every statement from policymakers, particularly from someone like POTUS, has the potential to shift settlement. This similar to what we see with tariffs or other macro policies. The market reacts not only to facts, but also to expectations created by signals. So As far as I'm concerned, if you're looking at the trade from this, in my opinion, the framework is correct. If this is correct, my opinion, not financial advice, positioning logic in oil becomes relatively straightforward. Institutional macro traders are primarily watching whether upstream infrastructure becomes a target. As long as that threshold does not cross, rallies in oil are likely to be treated as opportunities to reduce exposure, initiate tactical shorts. From a price perspective, base case, no upstream infrastructure is hit. Oil remains contained in the 80s, low 80s to low 90s, and rallies above 90s begin to fade. Not advice, my opinions. Escalation scenario. Geopolitical rhetoric intensifies without strategic damage, structural damage, pushing crude temporarily towards 93 and 94. Supply shock scenario. Confirmed strike on refineries or production facilities removes capacity from the system, could rapidly push oil again much higher. Right now, most institutional investors appear to be operating under the assumptions that cool heads will prevail and the escalation will remain below the threshold that would trigger a genuine supply crisis. Global winners and losers. Higher oil prices redistribute capital across the global economy. Exporting nations such as Russia and Saudi Arabia benefit directly from higher crude prices. Import-dependent regions such as Europe bear the economic toll, unfortunately, paying higher prices. China sits somewhere in the middle. So when volatility can create short-term disruption, China maintains diversified energy. Key macro takeaways. Oil is trading a geopolitical risk premium, not a confirmed supply shock. Current prices in the mid to upper 80s, 87.54, reflect fear and headline risk rather than actual structural damage to the energy system. One note, we're going to have to see what happens, how it plays out with the news breaking from CNN, if that's verified about them mining the strait. Short-term upside remains possible. Momentum and geopolitical rhetoric could push oil towards 93, 94 in the near term. The 120 oil scenario requires upstream destruction, ladies and gentlemen. We got to see a lot of destruction for that action to happen. And you're really going to have to sit there and say that both sides really despise each other and going to have to do that. I don't know. Only confirmed strikes on refineries or major production facilities would justify a sustained move towards those levels. Institutional traders are likely selling rallies. Everyone I know is. Without upstream damage, many macro funds will treat sharp spikes as tactical selling opportunities. Global impacts are uneven. Energy exporters benefit from higher prices while major importers regions, particularly Europe, absorb the pain. Ladies and gentlemen, that's the most important thing. So over the weekend, there were reports that the 82nd Airborne, that's America's QRF, that they get the call first, that they were canceling certain things and they had to report to base. I don't know if they were being briefed and speculation about going over to seize that island that everyone talks about, right? At least I know. Most people probably never heard that island. If you got to rewind and go back to that island, you could seize that island very, very fast. That outfit, that historic storied outfit, that famous outfit and storied outfit of the U.S. Army. Salute to them. That's what they do. But I want to go over something. This is important right now. If there's a de-escalation scenario and you have a high conviction of de-escalation, you're going to be, my opinion, not financial advice. People are long gold, they're long equity, U.S. emerging markets in Korea. You're shorting USD, high beta, emerging market FX. Again, depending on if you have the lowest conviction, then you know about a de-escalating scenario, you're long euro equity, you're long short end euro rates, you're short oil. Again, it's how you perceive this. If you're somewhere in the middle, you're long carry EM rates, credit tighteners, intra-EMU tighteners. Again, but if escalation scenario, right, this is what I've been telling a lot of people. I'm trying to jam all this into your head right then and there. Again, if the escalation scenario goes higher and the highest conviction, you're long oil, you're long USD, long inflation break evens. If you're somewhere in the middle, again, not financial advice, my opinion, you're looking at, I would say there's no in the middle of that. You're looking at long gold curves and you're looking at just waiting to digest plays. Ladies and gentlemen, the market's being driven now by news. What we're paying attention to very much and what I'm discussing with people is I'm going over the things that we discussed last video, the sulfur shortages. I'm looking at how long it will take certain things to get to where they're going. The supply shocks, the argument between copper processing and nickel processing, again, fertilization, we're looking at plays for that. We're looking at LNG plays, again, the ones that I mentioned in our Patreon, the Crypto Republic Trading Monthly Desk. We're following those because, again, that is the lowest hanging fruit. But right now, if you want to learn more about this, come and join us. Again, one tips from the pits pays for your entire year. So everyone who's there already paid for their entire year from the oil things from Dominico, had to the Dominico. But if you look at what's happening right now, that's what's happening. So very interesting. POTUS came out and said some things. The movement of strategic bombers to areas in Diego Garcia and the UK pushed things down. Other NATO allies who are sending ships into the regions potentially to defend their own interests, again, things slowed down. The de-escalation came in. So you got a seesaw. You got escalation plays, de-escalation plays. And you got everyone guerrilla playing the entire thing, ends against the middle. So this has set a range for people to take advantage of. And that's why I said it's our obligation. We're feasting right now. People are getting cut up like sushi. This is easy to get the lowest hanging fruit if you see what's happening. If not, you're getting cut up like sushi. This is why you got to have the Gucci conviction. You got to have the Gucci clarity. You got to have that. Why Jesse Livermore said small trade sizes. How this affects XRP and everything. Ladies and gentlemen, the DTCC is coming out with a lot of news. Breaking. Again, I don't do price predictions. I believe in accumulation at levels. So you can see the moment that the escalation seesaw went down instead of up, money flowed out of those things and right into the cheapest, most on-sale plays, the crypto market, XRP, ICP, HBAR, XLM. Again, people are accumulating. They're putting it away. You take alpha from one place and you buy something else that's undervalued and you put it away. Time is your friend here, not your enemy. Again, you have to understand this right now. This is what's happening around the world. And you're going to see social media influence the markets. I can't believe I'm saying this. I had to say this to some family offices, and the best is this. When they watch these videos, they actually laugh, and they last a lot longer because they understand what's happening. People want to understand what's happening. They don't just trust the people working for them. They want to understand what's happening and why. Because in today's world, things are moving very fast. You know what's amazing? Look at how much oil is being traded on Hyperliquid. Look how much oil is traded on these exchanges, crypto exchanges. It's a new world. This year, so far, these whole scenarios has the potential to generate blockbuster alpha returns in certain spaces if you know what you're doing and you are using your own strategy. For us, we wait years for these situations to happen. Years. Because we're following the same textbook play. I learned about so many of these situations on the For the Mercantile Exchange, and I've lived and traded through enough of them to understand what's happening from the physical side, the future side. Again, the things we love, LNG, loving LNG. LNG, baby, all the way. Loving sulfur all day, every day. Because you think they're just going to start shipping out shipments right now through the strait? You have supply disruptions that are going on for a long time. If this is the opening chorus and salvo of the chaos chorus today, they're going to mine the strait. You better believe there's things that are going to go on that it's going to influence up, down. But remember, we're talking about escalation scenario, de-escalation scenario. I'm sorry, I'm looking at the clock because I have to get on the phones right after this, but I want to make sure I have stuff and videos for everybody because I actually miss when I miss you guys when I can't make a video. I love you all. I love your comments. I love the energy of our wolf pack. I love seeing people get excited. I love when people come here and they get that Gucci conviction. They get that Gucci clarity. And I can see it in the comments that you guys write. I see it and I love it because I said he and she, they get it. They get it. They see what I'm seeing, right? And I love it. And if you're new here, please subscribe because my rants, and if you made it this point, they build on each other. But ladies and gentlemen, that's what's happening. And right now, I'm taking, and in my opinion, as much advantage of XRP, ICP, HBAR as we can at these depressed levels. And if you don't have what you want right now, don't worry because this chaos, this isn't going away tomorrow. It's not going away tomorrow. Not going to go away tomorrow. You got time. Be patient. I always tell you, pay attention to what's quiet, ladies and gentlemen. Pay attention to what's quiet. And I have one other thing that I think is very, very important. I see all these comments, and remember, ladies and gentlemen, this content is for informational and entertainment purposes only. It should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions, always. Ladies and gentlemen, nothing's going to, as far as I'm concerned, in my opinion, nothing is going to overnight change crypto prices. Nothing's going to change it all overnight. Time is going to change it. Theta is going to change it. Theta is going to change it. Nothing overnight is going to do that. So if you're expecting to wake up tomorrow and see something in 3 or 4 numbers, you're going to be sadly mistaken. And I'm sorry. And if you want to complain, drop a comment and I'll answer that, but it's not going to happen like that. Time is on our side here. It is. So use strict money management right now. Things are changing in front of our eyes. And that's all you need to know, that it's begun. It's begun. Someone asked me if I know about some domino theory. I have no idea what someone's talking about, a domino theory. I don't know what that is, unless you're talking about what the United States dealt with in Southeast Asia during the Vietnam, and every country would become communist. I don't know what that is. Again, ladies and gentlemen, what a time to be alive. Be frosty. Be patient. I'll see you all on the front lines. Ladies and gentlemen, remember, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You have 2 choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves to never let it happen again, or you can be like the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally, because some moments in history are loud, but the ones that change everything are quiet, right up until the moment they're not. And this is one of those moments. Do not blink, because the world is distracting you with noise while XRP continues developing behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. You move now, be remembered. This is not the end of the story. This is just the beginning. This opened your eyes. Smash that like button, ring a bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to the Crypto Public. We break down the major global banking trends shaping digital assets today, giving you context, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the public. I love you all. See you in the front lines.